Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, what's the disadvantage? If you're taking notes, I think this is a very important slide because the disadvantages are something that people often overlook. This past slide, when I'm telling you about these wonderful things about the market moving way up or way down, you can make money either way, that's fun. But if you don't study this one a lot, I think you're in for it. I think you're asking for trouble as a trader, and I think your trading career will be cut short if you don't pay attention to what I'm about to say, if you've never heard this before. If you've heard this before, hopefully it's a good review, but if you haven't heard this before, I think this is very important. You have premium risk when you're buying a straddle or a strangle. And that premium risk is twice as much. Twice as much as what, you might ask? Well, if you buy a call option, you pay $100 for it, let's say. But let's say that you buy a call and a put, same strike prices or the same distance in terms of being in the money, at the money, or out of the money, then it's not $100, it's $200. And if the stock move or the underlying moves a little bit, then you may have made money if it was going your way with a call or a put if you would have picked the right one. Whereas with the straddle or the strangle, then you have a lot more premium to make up, and you're taking on premium risk. Folks, it's not about getting rid of risk. It's about shifting risk. Shifting risk is what option trading is all about. And when you're buying a straddle or buying a strangle, you're taking away the market risk, so to speak, and if the market goes way up or way down, you don't care. You're actually really happy about that because that's what you want it to do. However, you're shifting it, and the way with which you're shifting it is to premium risk. Premium risk is something that needs to be respected. This doubles the time decay risk. But with that being said, not only do you have time ticking against you in the call option, you have it ticking against you in the put option as well. So you have all those things working against you, but you get the privilege of making money if you do get that big breakout that you're looking for. Large movement is your friend. No movement is your enemy. Just like when trading stocks, the bulls are your friend, the bears are your enemy. Or if you're shorting stocks, the bears are your friend, the bulls are your enemy. Know your enemy. In this case, your enemy is if it does not move. Now, what if you're anti-delta? Let's say that you believe that the underlying is going to stay around the same area. You don't think it's going to move much. Well, if that's the case, you can sell a naked short strangle. You'll only have margin requirements on one side of the trade. So with that, that can be a pretty promising risk-reward if you're right. Once again, I want to emphasize, I said, if you're right. So that's when you're taking the other side of the trade. Boredom or non-movement is your friend. Movement is now your enemy. Disadvantage, you double your chance of losing. Instead of just selling a naked call or a naked put, now you have the naked call and the naked put to worry about. So you have twice as much of a chance of losing as opposed to just selling a single leg option. You now have unlimited risk when doing so. And the underlying must stay within a range. So there's advantages and disadvantages to everything. When you're trading straddles and strangles based upon price movement, that's how you can actually get hurt from doing so. Now what about Vega? Now we're going to get a little bit more advanced in talking about implied volatility. But with that, if you believe that implied volatility is going to go higher, one thing that you can do is buy a straddle. If you're looking at the volatilities on YUK, on AUX, on CDD, EUI, PZO, whatever, if you're looking at all of those and you believe that implied volatility is lower and you believe it's going to go higher based upon your analysis, a straddle could be something that could benefit you. Based on the fact that assuming all other option pricing factors remain constant, if volatility increases, then the values of the option will increase. Now, of course, if you believe volatility is going lower, then you can sell a naked short straddle. If all other factors remain the same and volatility decreases, then you will benefit because the option values will go lower. With that being said, you have to respect the other factors of option pricing when doing this. You need risk management for any trade, whether you're buying an option or selling an option. So if you're long the straddle, you got to respect that time decay risk that's going on. You have to respect the fact that if the stock market doesn't move, then it's going to hurt you in time decay. And if you're playing volatility, you better hope that that volatility moves, or you're going to be wrong. Not that this is bad or good for that matter. You just need to be aware of the risk involved. Never fly blind. Understand that anything can happen when trading with any factor of doing so. Last but not least is theta. Now, the sun rising tomorrow is the only guarantee in all of trading. With that, the fact that I got the word guarantee through my compliance department to get this actually up on the screen is amazing to me still to this day. But with that being said, there is a guarantee that the sun's going to rise tomorrow. And if for some reason it doesn't, I dare you to come after me because we're all probably going to be dead anyway. So with that being said, if you're selling short a straddle or a strangle, that takes advantage of that. You have time decay working in your favor on both the naked call and the naked put. That's a wonderful thing. However, you need to respect the premium risk if you're long, and you need to respect the market risk if you are short. Market risk, of course, meaning that you're naked a call and naked a put. Premium risk if you're long a call as well as long a put. So with that, we've talked about the straddle and the strangle, why you would consider all of them. Why would you consider this with currency options? Well, with this, we're talking about short-term trading today, and I've talked a little bit about, or Steve and I talked a little bit about some ways with which you can use this in the long-term portfolio and how it could make sense depending on your situation. But why would you consider doing short-term trading with currency options? Well, let's say that you are a long-term bull and you have long-term bullitis, and it's just hard for you to buy puts and look at the market objectively. Well, with currency options, chances are you don't have any preconceived notions in terms of short-term, whether the dollar will go up or the dollar will go down. Maybe you do, maybe you don't. I don't know. Every individual trader is different. But this is a way with which you can kind of sidestep the stock market as a whole. Let's say that you're basing your retirement on the U.S. stock market and you need it to go up, and it just kills you to do short-term trading of buying puts for short-term bearish plays, and it just doesn't work for you for whatever reason. Well, if that's the case, there's no law that says you're not allowed to trade the currency options. This is part of a gigantic overall market. With that being said, currency trading is it's often said that the FX market is the world's largest marketplace. And with that, currencies are something that do play a major role in everything that we do. I've done webinars in the past on hedging your life, so to speak, with currency options. I've done a lot of them relating to how currencies play a role in ways with which you don't even expect. And with that, this is something that's very big, the currencies as a whole. The other thing that I like about currency options, anything you do with stock options, you can do with currency options. I can buy a call option on Google. I can buy a call option on GLD. I can buy a call option on SLV, XLE, XLY, XLU, whatever, but I can do it just as easily on YUK, AUX, CDD, SFC, or any of the currency pairs that the ISE offers. If I'm concerned with volatility risk, I can do a spread. If I'm concerned with market risk, I can do a straddle or a strangle. Whatever I'm looking to do, I can do it on the currencies just as easily as I could do on the stocks. You can do these in an IRA. Not a lot of people know that, but if you're, I don't know about other brokers, but I know with us, you can do these in an IRA. So as a way of hedging your long-term portfolio, you can use currency options in an IRA.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.